cost of homes has risen far more than the wages most people use to pay for them.
Steady an ongoing slump in the housing market.
President Trump floated the idea of a 50-year mortgage. 50-year mortgage.
What if the global housing crisis isn't a failure of the system but proof that the system is working exactly as intended? In just 2 decades, home prices in many rich countries have doubled or even tripled, while wages barely moved. In economic terms, this is called successful asset inflation. They never clarify successful for whom though. In cities like San Francisco, London, Amsterdam and even Sydney, the average home now costs 8 to 12 times the average income. For young adults, home ownership has quietly slipped out of reach. The average first-time buyer is now over 40 years old. Birth rates fall, families are delayed, and millions are forced to rent indefinitely. Nearly half of renters in advanced economies now spend over 30% of their income just to stay housed. Many spend more than 50%. At the same time, household debt keeps rising, yet governments openly admit they don't want prices to fall because high home values prop up voters' wealth, bank balance sheets, and of course financial markets. So prices stay high. Debt replaces growth and opportunities shrink. This isn't bad luck, it's policy. Which future does the system create? Tell us your opinion in the comments below. Before we continue, don't forget to hit like, subscribe and share this video, because what comes next explains why this crisis is not an accident. When housing gets expensive, the danger doesn't stop at the front door. It spreads through the entire economy.
In many advanced countries, housing is now the single largest driver of household debt, with mortgages making up over 70% of total household liabilities. This debt boosts short-term growth. People borrow, spend, and feel richer. But later comes the payback. Families cut consumption to service loans, slowing economic growth and increasing the risk of financial crises. The Economist warns, this pattern makes economies more fragile, not stronger. There's another hidden cost: misallocated capital. When trillions are poured into inflated homes, that money isn't funding startups, productivity, or innovation. It's locked into land. And in the most productive cities, the damage is even worse. Housing shortages restrict who can move in, capping job creation and competitiveness. Research shows that cities with tight housing supply grow significantly slower than they should.
What looks like prosperity is often just debt in disguise, and the time bombs tend to explode when rates rise. Housing inflation doesn't just distort markets, it quietly reshapes society.
In cities like London, San Francisco, and Amsterdam, teachers, nurses, police officers, and service workers are being pushed out because they simply can't afford to live near their jobs. Long commutes replace community, and essential services start to break down. For renters, the pressure is relentless. In many advanced economies, nearly 50% of renters now spend over 30% of their income on rent, and millions exceed 50%. To cope, households cut back on healthcare, delay education, and sacrifice basic quality of life. Not by choice, but by necessity. Even homeowners aren't safe. Many are house rich, cash poor, sitting on paper wealth while struggling with daily expenses. Some turn to risky products like home equity loans or reverse mortgages just to stay afloat. And as prices rise everywhere, mobility collapses. People can't move to where jobs are. Opportunity freezes.
This is how housing inflation locks societies in place and quietly decides winners at birth. What has housing costs forced you to give up? We want to hear your story. Please share it in the comments below. This is the moment where the idea of housing accident completely falls apart. And here is why.
For decades, governments have actively subsidized demand instead of supply. State-backed mortgages, buyer tax breaks, and loan guarantees pour more money into the same limited number of homes, pushing prices higher. In the US, government-backed agencies now support nearly half of all mortgages, massively amplifying demand. Central banks deepen the problem. Years of ultra-low interest rates let buyers borrow more while keeping monthly payments manageable. Prices exploded, yet ownership barely changed. In many advanced economies, home ownership rates are roughly the same as they were 40 years ago. Politicians increasingly admit what was once unspoken. Falling home prices are politically unacceptable because housing is the largest source of wealth for most voters, especially older ones who turn out at elections.
Instead of lowering prices, governments promote mortgage gimmicks, Extending loans reduces monthly payments but can add hundreds of thousands in extra interest over a lifetime. Affordable housing isn't blocked by accident, it's a protected way. Housing is no longer treated as a place to live, it's treated as a financial product. In many countries, private equity firms and institutional investors now buy thousands of single-family homes at once, often paying cash and outbidding regular families.
In the US, investors already own roughly 1 in 4 homes in some major cities, and forecasts suggest they could control close to 40% of single-family rentals by the end of the decade. Scarcity is profitable. When supply stays tight, rents rise. Since 2010, rents in many advanced economies have increased more than twice as fast as wages. Fees, penalties, and constant turnover extract even more value from tenants who have nowhere else to go. This system feeds much larger players. Pension funds, banks, and insurers hold housing debt and rent streams inside complex financial products. Their returns depend on prices staying high.
In housing where affordable and stable, much of this financial machinery would stop working. The housing crisis isn't just a national problem, it's a global phenomenon affecting rich and middle-income countries alike.
In the Netherlands, demand subsidies combined with weak supply controls have pushed Amsterdam home prices up by nearly 80% over the past decade, making it unaffordable for young families. Germany has seen rents rise 40% in major cities like Berlin and Munich in just 5 years, driven by migration, shrinking household sizes, and stalled construction. In Australia, median house prices in Sydney now exceed 12 times the average income, while New Zealand's Auckland has seen prices triple since 2000, as strict local opposition blocks denser development. Yet some exceptions show what's possible. Japan's flexible zoning and abundant housing supply have kept Tokyo home prices stable, with prices only rising about 20% in 2 decades despite high demand. Vienna stands out in Europe. Nearly 60% of the population rents in city-owned social housing, keeping living costs manageable.
The pattern is clear. Expensive housing is not inevitable. It is a deliberate outcome of policy and planning choices. So, as you could see, expensive housing doesn't exist by mistakes. It boosts paper wealth without creating real prosperity. It protects political coalitions that rely on rising home values. It feeds financial markets built on mortgages, rents, and scarcity, and at the same time, it quietly erodes social stability. High prices lock younger generations out of ownership, delay families, and push workers away from opportunity. That replaces real growth. Mobility collapses, inequality hardens, yet the system keeps moving in the same direction because fixing it would mean falling prices, shrinking balance sheets, and a painful shift in power. That's why real solutions are always postponed, diluted, or replaced with cosmetic fixes that sounds bold but change very little. The housing crisis is not broken, it is working exactly as designed. Now the real question is this: should housing be a place to live or a machine for profit? Let me know your thoughts in the comments below, and don't forget to hit like, subscribe and share this video so you don't miss our upcoming content. The next one's already brewing. Stay tuned.